Hello, it's Bob Steele. In this video, we will continue on Chapter 3, Learning Objective 4, which is to compute a predetermined overhead rate and explain its use in job order costing for job shop and batch production environments. Alright, so the manufacturing overhead costs. So we're talking about manufacturing overhead. Remember, we're trying to talk about these things like depreciation on the factory. We're talking about indirect labor. We're talking about the small materials that we can't apply directly to a job because it would be too difficult for us to do so. So something like the depreciation, we may have a lot of jobs that we are producing. Those jobs are all not the same. Remember, they're different, and therefore we can't just allocate to the jobs at a constant, just divide it out by the jobs. We have to find some way to allocate the jobs that are in different proportions, different size jobs. So what we're going to do is we're going to have the overhead is applied to the job using a predetermined overhead rate. So what we're going to have is this, and based on the estimates made at the beginning of the accounting period. So here we have the predetermined overhead rate here, which is going to be calculated as the budgeted manufacturing overhead. So we're going to predetermine what we believe the budgeted manufacturing overhead will be, meaning all this stuff that's going to go into this account. And of course, we're going to do that probably based on last year and any changes that we think will be made in the upcoming year. So budgeted amount of cost driver. So then we're going to divide that by the cost driver. So remember, if we're talking about something like construction jobs or something like that, we may use something like direct labor hours, because the direct labor hours, how many hours are put into a job, is often a fairly good indication as to how big one job is compared to another job. So that is why hours are often used. So then we're going to take the overhead applied times the actual overhead. So when we actually apply out the job, when the job comes in and we actually do the job, then we're going to say we're going to take those direct labor hours on the job and apply them times this rate that we came up with up here. So based on estimates and determined before the period, that's what the overhead applied rate is here. But the actual amount of the allocation base, such as the direct labor hours, is what we're going to multiply it by when we actually make the allocation of the overhead to a particular job. So manufacturing overhead cost, overhead is applied to jobs using the predetermined overhead rate based on estimates made at the beginning of the accounting period. So once again, same formula here, the budgeted manufacturing overhead on the top divided by the budgeted amount cost driver. That's how we come up with the predetermined overhead rate that we will then use to allocate the job. So remember, when we apply out the job, meaning when we get our job system and our job cost sheet and we're applying the overhead to the job, we're going to take this predetermined overhead rate that we predetermined, multiply it times the actual activity, being, in our example, was the hours. So recall that the aluminum boat was $30 times the direct labor hours. And that's how we came up with the 18 there. Objective number 5, prepare journal entries to record the cost of direct materials, direct labor, and manufacturing overhead in a job order cost system. So, job order costing document flow summary. Let's summarize the document flow we have been discussing in a job order cost system. So remember, we're talking about the inventory, the asset, the production of the inventory in a job order cost system. We're making something and that we do plan to sell, of course. And if we're talking about like construction or something like that, the start of the process, the production order for the job, authorizes the start of the production process. So we're going to get a new job order process happens. First thing we're probably going to do is get materials for that job. So once again, if we're doing construction, we got a new job, we might need, wood or something for a construction job. If it was something like that, we would then requisition that wood. The materials requisition indicates the cost of direct materials to charge to jobs and cost of indirect materials to charge to overhead. Then we're gonna have the labor time records. We're gonna somehow apply the time, the direct time in this case, to the job. Oftentimes, employee time tickets indicate the cost of direct labor to charge to jobs and cost of indirect labor to charge to overhead. So remember, indirect labor and indirect materials are those things that we don't know which job to apply it to. Indirect materials be things probably that are small. So if we're talking about like the grout or something in a construction job or something like that, maybe we don't want to apply it directly to the job because it would be too cost effective to do so. So therefore, we would put it into overhead and use an activity base to apply it, which may be easier and less costly. Indirect labor might be something like the supervisor's salary. And then we're going to apply the overhead to the job. We're going to take the actual cost driver, which might be labor hours, times the predetermined overhead rate in order to apply the overhead, being, once again, those small things, such as the indirect material and the indirect labor. Job order system cost flows. Let's examine the cost flows in job order cost system. We will be using the good old T accounts and start with materials. Alright, so here's our T accounts. Remember the T accounts, we have the debits on the left, the credits on the right. We're talking for the most part in the beginning here about assets because we're talking all about the inventory here. So inventory starts at raw materials, then it goes to work in process, and overhead could be in the asset area. That could also be in cost of goods sold, but it's going to be a kind of a clearing account that will have stuff in it and then be cleared out at the end of the day. And then it will go to finished goods. So raw materials, work in process, finished good, all assets. Assets have debit balances. How do we make something go up? We do the same thing to it. So debits make asset balances go up for the most part, and credits make them go down. Therefore, raw materials, when we purchase raw materials, we're going to debit raw materials. We're going to credit cash when we purchase it. We've got it in raw materials. Then we got a job acquisition form. Acquisition form will generally apply the direct materials to work in process. That would be a debit to work in process, increasing this asset, crediting materials, decreasing this asset. Indirect materials that are requisitioned would go to manufacturing overhead because, once again, we couldn't apply them directly to the job because we don't know how much the job will really take. We don't want to calculate that because it would be too costly to calculate something for a small item. So therefore, we're going to credit materials, decrease in materials, and debit this this is just the bucket of everything we don't know where to put it, which is the manufacturing overhead, increasing that. Next, let's add labor cost and apply manufacturing overhead to the job cost flows. Also want to point out that when we put this here, this must be backed up by our job cost sheet. So the job cost sheet we looked at in the prior section of Chapter 3 would be backing up this number. Anything that is in work in process should be backed up by a job cost schedule, and in a similar way that an accounts receivable account would be backed up by an accounts receivable subsidiary account by customer. The work in process is going to be backed up by a job cost sheets. Okay, so now we're going to look at the direct labor. So when we talk about direct labor, when we talked about a service company, what we would do when we process payroll, you can think about it as we used to debit payroll expense and credit the cash or wages payable. In this case, we're still going to credit wages payable, but the work that these people are doing is going directly into an asset, not being expensed. Therefore, the debit is going into work in process for the wages for the people who are working on this asset. For example, if we're working on a job and the job hasn't been completed yet and we can't bill it yet, then we have to debit the asset rather than the job. And then when we sell the job at the end, we'll debit cost of goods sold, and that's when we'll expense it. And so therefore, we're going to debit work in process. Once again, it should be backed up. Anything that hits work in process will be backed up by that job sheet. And if it's indirect, something like the supervisor's salary or the janitor of the factory or something like that, then we're going to credit wages payable and debit the manufacturing overhead, that bucket that we're going to have to somehow allocate. Remember, we want this stuff over in a job, but we don't know what job to apply it to. So we can't do that yet. And we're going to do that with an estimate. So that happens here. And if the actual applied manufacturing overhead are not equal, a year-end adjustment is required. We will look at the predetermined. So then we're going to take the manufacturing overhead and apply it to the work in process. So this amount in manufacturing overhead, we're gonna use our ratio and apply, using the predetermined rate, the manufacturing overhead to work in process. So therefore, we're going to credit manufacturing overhead, making it go down, debit work in process, making it go up. Once again, this will be backed up by the job cost sheet. This is going to be an estimate. These three debits are all increasing the work in process account. They can all be backed up by job cost sheets, and that's the flow as we go. Now let's complete the goods and sell them. Still with me? Yes. Okay. So now we have the work in process. We're done with this particular job. Therefore, we're going to decrease work in process. Remember, this is an asset, so we're going to decrease it with a credit. So we're going to credit work in process. We're going to move it to finished goods. Finished goods being obviously finished. Also an asset, also inventory. Therefore, assets have debit balances and they go up with another debit. So we increase the finished goods. And once again, the finished goods and the work in process will be backed up by the job cost sheet. The job will be closed over here. It'll be open over here. And then once we sell the goods, then of course, we don't see the sales sides in this worksheet. So the sales would be credited, accounts receivable or cash would be debited for the sales half. And then the cost half of a sales transaction would be to decrease the finished goods being an asset. To decrease it, we would do the opposite, which is credit it, and then we would debit the cost of goods sold being an expense. So now we're on the income statement here, and this is an expense on the income statement where we were on the balance sheet before. Income statement meaning we're finally recognizing the expense related to us using the assets, which consist of direct labor, direct materials, and overhead of our inventory in order to achieve our goal of generating revenue. So that finally happened here. That's why we recognize the expense here. So we would debit accounts receivable, credit sales, debit cost of goods sold, and credit finished goods. The effect on net income would be sales minus cost of goods sold would be how much our net income would have gone up at that point in time. Let's return to the AFB company and see what we will do if actual and applied overhead are not equal. So remember, the overhead was just an estimate. So the actual overhead costs, we know what the actual overhead costs will be at the end of the period, but we applied them out based on an estimate at the beginning of the period. So actual direct labor worked was 170. So applied overhead, we used this $30 rate times the 170, and we applied out over the year 5,000,001 instead of 5,050,050, and therefore we've got this difference of the 50. This difference is called overapplied, and that's always going to happen because it's an estimate. So at the end of the day, we want the overhead to clear out, and we want to apply it all out. But because it's an estimate, we're using a predetermined estimate rate. It will never be perfect. So we're going to have to do something with that 50 in overhead because we don't want it sitting there. We're going to have to apply it out at the end of the period. Hopefully it's immaterial to, this 50 is immaterial compared to the 5 million. Therefore, hopefully, we can apply it out and it's not a big deal because our estimate is good, and we could just fix the estimate going into the future and improve it as best we can as we go forward. A couple options to clear out the overhead account. We want to make the overhead account 0. Therefore, the 50 may be allocated to one of these accounts. We can either go to work in process, we can allocate it to finished goods, we can allocate it to cost of goods sold. The 50,000 may be closed directly to cost of goods sold in this case. And the easiest thing to do if it's an immaterial amount is to close it out to cost of goods sold, because cost of goods sold will then close out to retained earnings, and we won't have to kind of worry about it anymore. So if it's an immaterial amount, the easiest thing to do would generally be to just zero out the overhead account for any estimating difference at the end of the time period, and apply the difference to the cost of goods sold account. So overapplied and underapplied manufacturing overhead. So if cost of goods sold account, unadjusted balance, ABC's manufacturing overhead for the year. So what we're gonna do is we're gonna take that amount and we're just gonna apply it out to the cost of goods sold. So we're putting this 50,000 in the overhead account in order to just zero it out, and then we are crediting, in this case, cost of goods sold. And this is bothersome to a lot of people because cost of goods sold is an expense account, and we almost never decrease an expense account. They usually only go up. But in this case, that's kind of an exception to the rule because this is a the idea is it's an immaterial amount compared to the sales of the company, and therefore it won't make a difference in ultimate decision making, and therefore it's appropriate to close out because it is an estimate. So here's a recap of what we just kind of went over, the two scenarios for closing out the cost of goods sold. We can, whether it's underapplied or overapplied, the options are basically to close it out to, make the account 0, the overhead account 0, because it's supposed to clear out. Then we can either hit work in process or finished goods, or we can just close it out to the cost of goods sold. Cost of goods sold being the probably the easier of the two methods. And that is it.